If you are close enough to retirement that time suddenly feels expensive, then I want to tell you something most people discover too late. Your last big wealth opportunity will not arrive looking safe. It will arrive looking messy, uncomfortable, and badly misunderstood. That is how these windows always show up. They do not come dressed like a polite brochure from a wealth manager. They come dressed like force-selling ugly headlines, strange sector moves, and television anchors telling you the world is getting harder to understand. That is when most people step back. That is why most people miss the window. I learned a long time ago that markets do not hand out life-changing opportunities in tidy packaging. They hand them out inside what I call the clearance room. That is the single picture I want you to hold in your head. Not a market, not a portfolio, a clearance room. In that room, almost everything is noisy. Some things are damaged, some things deserve to be marked down, some things are there only because they were overpriced nonsense to begin with. But a few things are sitting there because another part of the system got forced to sell, another part got structurally repriced, or another part is becoming more valuable than the crowd yet understands. That is where wealth changes hands. Not because the crowd suddenly became stupid, because the crowd became emotional. Emotion is what creates the markdown. Preparation is what lets you buy it. And if you are heading toward retirement, or even just thinking seriously about the years when you will no longer be able to repair mistakes with another decade of salary, this matters more than it did when you were 30 at 30. Time is forgiving. At 60, time becomes strict. That is why I do not think the last big wealth window before retirement is about chasing the hottest story or owning the prettiest chart. I think it is about learning to walk through the clearance room correctly. You have to know which shelf you are looking at. You have to know why the item is marked down. You have to know whether the markdown is temporary pressure, structural scarcity, or a new wave of money coming into a corner of the market before the crowd notices. That is what this whole story is really about. Most people think crises create only danger. They do create danger. But danger is not the most interesting thing a crisis creates. A crisis creates sorting. It separates sellers from buyers. It separates forced liquidation from patient accumulation. And when you understand that, you stop asking a weak question. The weak question is this market scary? Of course it is scary. The stronger question is, what kind of markdown am I looking at? That is where adults make money. Now, the reason I believe this particular moment matters is that we are not looking at one simple trend. We are looking at three different kinds of opportunity arriving at once inside the same clearance room that almost never happens cleanly. And when it does happen, it tends to define a portfolio for much longer than people expect. The first thing on the table is forced selling. The second is structural repricing. The third is innovation money. That is the whole room. And if you understand those three tables, you do not need the noise. You can ignore a remarkable amount of nonsense once you know which table you are standing at. Let me start with the first table. I call it the forced exit table. This is my favorite kind of chaos because it confuses weak investors and rewards calm ones. A forced exit has nothing to do with the long-term value of the asset being sold. That is the part the public always misses. The public sees the price drop and concludes the thesis is broken. Often the thesis is not broken at all. The holder is broken. Those are very different things. When a country sells gold because it needs dollars to stabilize its currency or fund an emergency, that is not the same thing as that country deciding gold suddenly became foolish. When a sovereign wealth vehicle sells bullion because it needs liquidity under stress, that is not the same thing as an intellectual surrender. On the role of precious metals in a system running on deficits, de-dollarization pressure, and war finance. This distinction matters enormously because if the seller is being pushed by necessity rather than by conviction, then the markdown can be a gift. That is what I see in gold and silver right now. A great many investors are making a childish mistake. They see bullion prices get hit while oil is exploding and they say, well, then the whole gold story must have been fake. Number that is lazy thinking. The more sophisticated reading is that some big holders got shoved into the market at the wrong moment. They sold because they needed liquidity, not because the long-term monetary case for gold disappeared. That is why I call it the forced exit table. The asset is not always the problem. The owner is. I want you to really sit with that. If I own a wonderful business and I am hit by some unrelated margin call, divorce, regulatory seizure, currency event, or liquidity demand, I may be forced to sell the wonderful business. Anyway, my sale does not suddenly make the business bad. It makes me desperate. That is the essence of a forced exit. And if you are the buyer on the other side of that desperation, you can get paid very well for staying calm. Gold is the cleanest example of that table because the long-term case is not difficult to understand. Governments are still running enormous deficits. Defense spending is still rising. The currency system is still being managed by central banks that always prefer inflation to honest liquidation if the debt burden grows too heavy. Central banks around the world still want more gold, not less, because gold remains the one financial asset that is not somebody else's promise. That is the case. Now, compare that case to the immediate price action caused by emergency selling from countries or funds that needed to raise cash right now. Those are not the same story. One is structure, the other is stress. That is why I smile when I see forced selling in a real asset whose structural demand has not changed. Silver is even more interesting because it sits on the forced exit table with two engines under the hood. The first engine is monetary, the second is industrial. That makes silver noisier than gold and often more painful in a liquidation wave. But it also makes it more explosive later, because when forced selling exhausts itself, the industrial demand never really left. It was sitting there underneath the whole time. Now, I am not telling you to run out and buy metal with your rent money. I am telling you to understand the table. A forced exit markdown is one of the few moments in markets where the patient investor can buy the long-term thesis cheaper because somebody else had a short-term emergency. That is a very attractive asymmetry. The second table is even more interesting because it does not begin with forced selling. It begins with structural repricing. I call this the necessity table. The necessity table is where an old, ugly, underloved corner of the economy suddenly becomes more valuable because the world remembers it still solves a very real problem. This is where coal enters the story. Now, the phrase alone makes certain people uncomfortable, which is usually a good sign in investing. Whole sectors become mispriced when too many people are deciding with identity and politics instead of economics. I am not arguing with anyone's moral preferences. I am telling you how price gets set in the real world. High oil prices change the economics of substitution. That is the simplest way to say it. When oil and gas become expensive enough, the things they displaced begin looking useful again. Especially if those things were starved of capital for years, because the entire investment community decided they were too embarrassing to touch. That is the setup in coal. Coal became socially toxic before it became economically obsolete. That is a very important distinction. When a sector gets starved of investment for ideological reasons, while the world still needs what it produces in certain scenarios, the stage gets set for a violent repricing later. That is what the necessity table looks like. The world is suddenly reminded that it still needs the thing, and the people who ignored it because it felt unfashionable now have to pay up. This is not only about power generation, it is also about steel. You do not build infrastructure, militaries, bridges, rails, transmission lines, heavy transport systems, and industrial expansion out of hashtags and moral applause. You build them out of steel. And steel still has a relationship with coal that the crowd likes to forget during periods of ideological certainty. That is why I think coal is so interesting here, not because it became lovable, because it became necessary again in a tighter, more expensive energy world. That is the difference between a fad and a repricing. A fad depends on attention. A repricing depends on function. Function always wins eventually. The crowd can ignore function for a while. It cannot ignore it forever. And that is why certain coal names or coal-linked exposures can move so hard when the energy map tightens. The market is not suddenly becoming nostalgic. It is rediscovering necessity. You should learn that lesson because it applies far beyond coal. The best opportunities before retirement often do not come from the shiny new thing everyone already agrees is wonderful. They come from the ugly but necessary thing the market spent too long underfunding. That is where the return comes from. The pain of owning necessity, while it is unfashionable, is the price you pay for getting it cheaper before necessity reasserts itself. Now let me move to the third table because this is where most people get seduced in the wrong way. I call it the innovation table. Innovation is one of the best wealth creators in the world and one of the easiest places to lose your mind. The reason is simple. Real innovation attracts real money, but it also attracts fantasy. The job is not to avoid innovation. The job is to understand where the money is truly flowing and why. Right now, the place I find most interesting is biotech. Not because biotech is safe. It is not safe. Biotech is where hope and capital often collide at high speed. That is precisely why position sizing and discipline matter so much. But the structural case right now is stronger than the average person realizes because this is not just a story about science. It is a story about a revenue hole, a very large revenue hole. Big pharmaceutical companies are heading toward a patent cliff. A patent cliff is one of the most predictable and profitable sources of acquisition pressure in the whole market. Massive drug franchises lose exclusivity. Generic competition appears. Revenue can collapse quickly. The giant companies know this well before television ever mentions it. So they begin looking around for the next pipeline, the next asset, the next small company with credible trials, differentiated science, or strategic value. This is how wealth gets transferred inside biotech. The crowd sees risk. Big pharma sees replacement inventory. That is a very different way of looking at the same landscape. And then you add artificial intelligence to drug discovery. That matters because the cost, speed, and efficiency of identifying viable candidates begins changing in a meaningful way. The innovation wave is not just more science for the same economics. It is potentially different economics for science. That is why venture money is pouring in. That is why merger activity matters. That is why the patent cliff is so important. This is not one story. It is three forces converging. An old revenue base is expiring. A new discovery engine is accelerating. And large buyers are being pushed into the market. That is a powerful setup. But now let me tell you the mistake most people make at the innovation table. They think innovation means they should behave like gamblers. Number, the innovation table is where you need the most discipline, not the least. Biotech has a brutal failure rate. Clinical setbacks happen. Approvals get delayed. Trials disappoint. Politics enters pricing. A single headline can turn a stock into confetti. So this is not where I would put the foundation of my retirement. This is where I would put a measured sleeve of intelligent speculation with clear rules, broad exposure when appropriate, and a mind for position sizing. You do not build your house out of fireworks, but you might keep a carefully sized box in the shed. That is how I think about biotech: asymmetric, real, institutionally supported. But dangerous if you forget what table you are standing at. Now, once you see the three tables together, the whole room becomes clearer. The forced exit table is giving you discounted real assets because somebody else needed emergency cash. The necessity table is repricing ugly but functional sectors because the world is being reminded it still needs them. The innovation table is drawing large institutional money into a future cash flow. Opportunity the crowd only half understands. That is a remarkable room, and this is why I say this kind of setup can define a portfolio for the next decade. Most people spend their entire investing lives waiting for one clean, obvious signal. It rarely comes. What usually comes instead is a period where the market gives you 3 or 4 crooked signals at once and asks whether you understand structure better than you understand comfort. That is the test. If you want to make the most of a moment like this before retirement, you need an operating system. Not opinions, not excitement, not envy of what somebody on the internet claims he made last Thursday. You need an operating system. Mine would look something like this. The first rule is that I would treat the forced exit table as an allocation decision, not a personality test. I would know in advance what percentage of my liquid wealth belongs in precious metals or related exposures, and I would respect that number, whether the price action made me feel smart or foolish this month. That matters because emotion is what makes people buy too much at the top and too little at the markdown. The second rule is that I would treat the necessity table like a contrarian industrial trade, not a moral referendum. I would look for underowned areas where high energy prices and tight supply are changing real economics. And I would keep my focus on the businesses or funds that truly monetize the shift, not the ones with the loudest story that matters, because in neglected sectors, quality still matters. A bad business does not become great simply because the commodity rose. The third rule is that I would treat the innovation table like a venture sleeve inside a disciplined portfolio, small enough that failure does not change my life, large enough that success matters, broad exposure when I cannot underwrite specific trial risk, concentrated exposure only when I genuinely understand what I own. That matters because innovation can make you rich or make you feel stupid, sometimes both in the same quarter. The fourth rule is that I would keep my core portfolio separate from my opportunity sleeve. This is especially important before retirement. You do not want your whole financial life to become one giant expression of your latest macro theory. That is how people end up having to work at 72 because they let one story colonize the whole house. Your core should still be built around resilience, cash flow, quality, and clarity. Your opportunity sleeve should sit on top of that, not replace it. The fifth rule is that I would start thinking myself as an allocator, not a spectator. This identity shift matters more than most people think. A spectator watches sectors move and says, "Interesting." An allocator asks, "Why is the money moving? What kind of money is it? And how much of my capital deserves to follow?" That is a completely different mental posture. A spectator needs validation. An allocator needs a framework. And if you are nearing retirement, framework is one of the most valuable assets you can own because it stops you from doing the two things that ruin older investors. It stops you from freezing, and it stops you from lunging. Those are the real enemies. The person close to retirement rarely blows himself up with one giant, obviously insane move. He usually blows himself up by staying too passive through a changing regime or by suddenly becoming too aggressive because he feels he is running out of time. Both are fear responses, neither is a strategy. That is why I find these three tables so useful. They create order. They tell you why something is moving. And once you know why, you can decide whether it belongs in your world. This is what Wall Street understands that most of the public does not. The market is not one kind of opportunity. It is several different kinds layered on top of each other. One asset is cheap because of a margin call. Another is rising because a global bottleneck just changed its economics. Another is re-rating because institutions see a future revenue transfer coming. If you treat them all as the same kind of move, you will size them wrong, hold them wrong, and exit them wrong. That is why understanding the table matters so much. The final thing I want to say is personal. Retirement changes the meaning of opportunity. When you are younger, you can waste years and still recover. When you are older, the last major wealth window matters more because time stops forgiving bad structure. That is why I do not think the right question is, can I get rich by Friday? I think the right question is, can I use this strange room full of force-selling, necessity, repricing, and innovation money to improve the next 10 years of my financial life before the easy windows are gone? That is the adult question. That is the question I would ask if I were standing near retirement and trying to avoid one of the saddest outcomes in finance, which is watching a great setup pass by because I insisted it needed to look cleaner before I acted. It will never look perfectly clean. That is why it pays. The room is messy. Good messy is where the markdown lives. Messy is where the crowd hesitates. Messy is why there is still value left for the patient. So let me leave you with this. The last big wealth opportunity before retirement almost never arrives in one beloved sector with a flashing sign that says, safe bargain. It arrives in a clearance room. One table gives you real assets sold by stressed hands. One table gives you underground necessity being repriced by reality. One table gives you innovation being funded before the crowd understands the transfer. And the investor who knows how to walk that room calmly with rules, with sizing, with patience, and with enough humility not to confuse opportunity with certainty, is the investor who gets to spend the next decade compounding instead of catching up. That is where I would rather be. Not asking whether the room feels comfortable, asking whether I understand the tables before the crowd finally does,